I still remember the first time I walked into a bank branch with a pitch deck under my arm and $27 left in my personal account. The marble floors were polished, the air conditioning cold enough to remind you who held the power, and the people behind the glass spoke in a language that had nothing to do with customers and everything to do with control. That day, I wasn't pitching a fintech startup. That word hadn't yet been polished into a buzzword. I was just a founder who believed that money should move faster, cheaper, and more honestly than the institutions that had been profiting from friction for decades. What most people don't understand about the rise of fintech is that it didn't begin with technology. It began with pain. Pain from small business owners, waiting weeks for loans from migrant workers, losing a month's salary, to remittance fees from ordinary people being told they were unbankable by systems that never bothered to understand them. Technology was just the weapon. Injustice was the fuel. Back then, financial services were a fortress. Banks didn't innovate because they didn't have to. Their margins were protected by regulation, their inefficiencies subsidized by customer ignorance, and their arrogance reinforced by scale. If you wanted to send money overseas, you paid whatever they told you to pay. If you wanted a loan, you filled out forms designed to exhaust you into submission. Startups didn't see opportunity at first. They saw walls. And walls are expensive to break. I watched founders burn through savings, trying to partner with banks that smiled in meetings and buried them in compliance afterward. I watched brilliant engineers quit because they couldn't survive another month of ramen and rejection. This is the part of the fintech story that never makes it into glossy conference slides before the apps, before the unicorn valuations. There was a long season of near starvation and humiliation. The first real cracks appeared not because startups were smarter, but because they were desperate. They couldn't afford legacy systems, so they built from scratch. They couldn't rely on brand trust, so they obsessed over user experience. They couldn't hide behind fine print, so they competed on transparency. Digital wallets didn't just make payments easier, they made people feel respected. Peer-to-peer lending didn't just offer loans, it told borrowers, "We see you as data, not as stereotypes." Robo-advisors didn't just automate investing, they invited a generation locked out of wealth management to finally sit at the table. Each of these innovations looked small on its own, but together they rewired customer expectations. Once people tasted speed and simplicity, the old ways felt intolerable. What really scared traditional institutions wasn't the technology, it was the cultural shift. Fintech startups spoke the language of users, not regulators. They shipped updates weekly, while banks scheduled changes annually. They failed in public and learned fast, while incumbents hid mistakes behind PR statements. I've sat in boardrooms where executives dismissed startups as toys, only to call me 6 months later, asking how to be more agile. By then, it was already too late. Because fintech didn't just attack products, it attacked profit pools. Fees that once funded executive bonuses were suddenly exposed as unnecessary. Middlemen that justified their existence for decades were replaced by APIs and algorithms. And the most dangerous thing of all happened. Customers realized they had a choice. But here's the uncomfortable truth that rarely gets told. Fintech didn't magically democratize finance. It shifted power, yes, but not always evenly. New gatekeepers emerged in the form of platforms, data owners, and venture-backed startups under pressure to grow at all costs. I've seen founders compromise their original mission the moment growth investors entered the room. Free services quietly introduced hidden fees. Financial inclusion became a marketing slogan instead of a design principle. Regulation once the enemy became a shield for those big enough to afford compliance teams. In other words, fintech began to resemble the very system it claimed to disrupt. This is not a failure of technology, it's a failure of human discipline. Still, the impact is undeniable. Open banking cracked open data monopolies. Real-time payments rewired cash flow for businesses living invoice to invoice. Alternative credit scoring gave millions their first access to formal finance. Entire countries skipped legacy banking and went straight to mobile money, proving that innovation doesn't flow only from Silicon Valley outward. The startups that survived weren't the ones with the flashiest demos, but the ones that understood finance as a lived experience. They knew that trust is earned transaction by transaction, outage by outage, crisis by crisis. They knew that money is emotional, and when you touch it, you touch fear, hope, pride, and survival all at once. As I look back now with scars from failed pivots and a few hard-won victories behind me, I see the rise of FinTech less as a revolution and more as a reckoning. It forced an industry to confront its laziness. It forced founders to confront their ethics. And it forced customers to confront their own relationship with money. The startups reshaping financial services today stand on a knife's edge. On one side is the chance to build systems that are genuinely fairer, faster, and more human. On the other side is the temptation to become just another empire extracting value behind a prettier interface. The technology will keep evolving, capital will keep flowing, and headlines will keep celebrating the next big valuation. But the real story of FinTech will always be decided in the quiet moments when a founder chooses between short-term growth and long-term trust, between exploiting user ignorance and educating them, between becoming the very institution they once swore to disrupt and having the courage to build something that finally breaks the cycle. By remembering why this movement started in the first place, when a few broke founders looked at a cold marble floor and decided that finance did not have to feel like this if they were willing to risk everything and keep going, even when the system pushed back and the nights grew longer, and the question stopped being whether the market would accept them and became whether they themselves could withstand the pressure of shaping an industry that touches every human life, without losing their soul and forgetting that reshaping financial services was never about apps or code, but about restoring dignity to people who had been ignored for so long. And that is where the real battle begins. Because once you win the user, you then have to decide what kind of power you are willing to hold and how far you are prepared to go when the numbers start to look good. And the temptation to compromise whispers that maybe just this once, it's acceptable to bend the values you once believed were non-negotiable. And that moment is where the future of FinTech is actually decided not in pitch decks or product launches, but in the silent internal argument that happens when no one is watching. And you realize that the next decision you make will determine whether you are building a tool that frees people or a machine that slowly tightens around them as it scales, and the weight of that responsibility settles in your chest, and you understand that from this point forward, every line of code, every pricing decision, every partnership choice will either move you closer to the world you promised to build or quietly pull you back into the same old system you thought you had escaped. And it all comes down to what you do next, and whether you are willing to keep choosing the harder path even when the easier one is, right there waiting for you to take it. And once that realization hits, you cannot unsee it. And the journey stops being about disruption and starts being about endurance and integrity. Because this is the part of the story where most founders discover that the real cost of reshaping financial services is not measured in capital raised or markets entered, but in the personal price you pay when you decide to keep going, even as the line between innovator and incumbent begins to blur, and you feel the gravity pulling you toward comfort and conformity. And you must decide, right then and there, whether you will resist it or let yourself drift. Because the next chapter begins the moment you take a breath and choose to move forward, knowing that nothing will ever be simple again, and that every win will come with consequences, and every compromise will leave a mark. And the only way to survive is to stay brutally honest with yourself about why you started and what you are willing to lose in order to finish what you began. Because from here on out, the rise of FinTech is no longer a trend or a headline, but a personal test of character that unfolds every single day as you step into a future that is still unwritten and waiting for founders who are strong enough to carry both the opportunity and the burden that comes with reshaping how the world handles money and trust at the same time, without looking away when the mirror starts asking uncomfortable questions about who you are becoming as the stakes grow higher and the applause grows louder, and the silence between decisions becomes heavier and heavier until you realize that this silence is exactly where the real work begins and where the next part of this journey continues without pause or ceremony, as you take the next step into a landscape where the rules are still being written, and the cost of getting them wrong is paid not only by you, but by millions of people who will never know your name, but will live with the systems you build. And that understanding is what separates those who merely ride the wave of FinTech from those who truly shape it. And that is why this story does not end here, but flows directly into what happens next as the pressure mounts and the choices narrow and the future demands an answer that cannot be delayed any longer. Because now you are standing at the edge, and the only question left is whether you will jump forward with intention or fall back into the comfort of the past as the momentum carries you onward into the next phase where the consequences become real and unavoidable, and the path ahead is defined by what you do in the moments when growth collides with values, and you must decide, without hesitation, which one you will protect, even if it costs you everything you thought you wanted, or let yourself slide back into the old comforts disguised as prudence. And this is where the story tightens, because from this point on, the game changes, and the enemies are no longer obvious institutions with marble floors, but subtle compromises dressed up as best practice and industry standards. And I learned this the hard way when our own product finally took off, and the numbers started to look good enough that people who had ignored us suddenly wanted meetings, partnerships, influence, and a say in how we priced, risk, and users. And it was intoxicating in a way failure never is, because success whispers instead of shouts, and tells you that you've earned the right to bend a little to charge a bit more here, to obscure a detail, there to optimize, not for users, but for spreadsheets. And that whisper is far more dangerous than outright opposition, because it sounds reasonable and mature and responsible. And I watched teams fracture at this stage, not from lack of talent, but from lack of alignment. As early believers realized the mission they bled for was quietly being reframed into something more palatable for capital and regulators and press releases. This is the phase of FinTech. Nobody prepares you for the phase where you are no longer fighting to survive, but fighting to stay honest, where the startup that once mocked banks for their fees starts justifying its own because the unit economics demand it, where data collected to help users suddenly becomes an asset to be monetized because everyone else is doing it, where speed turns into recklessness and innovation becomes an excuse to move faster than ethics can keep up. And the scariest part is that none of this feels like betrayal in the moment. It feels like evolution, like growing up, like becoming a real financial institution. And only later do you realize that you've been sanding off the very edges that made you different in the first place. I remember the night it finally hit me. We had just approved a change that would increase revenue significantly, without technically lying to anyone. Fully compliant, fully legal, beautifully justified by consultants who had never met our users. And I sat alone, looking at the projections, and felt absolutely hollow, because I could trace a straight line from that decision back to the very pain that made me start this company. And I understood then that FinTech doesn't fail when startups die. It fails when startups succeed and forget, because scale amplifies intent, and whatever values you compromise early get multiplied across millions of lives. Later, quietly, efficiently, without drama. And by the time anyone notices the damage, it's already baked into the system. The founders who endure are not the loudest or the most funded, but the most stubborn about first principles. They design pricing that hurts less even if it grows slower. They explain risk instead of hiding it. They build compliance into the product without letting it become an excuse for laziness. They accept that some markets will be closed to them because they refuse to play certain games. And yes, many of them will lose to competitors who are more aggressive, more flexible with the truth, more willing to squeeze users for marginal gains. And that is the unfair reality. Nobody on stage will admit, but the ones who survive with their integrity intact build something rarer than a unicorn. They build trust that compounds over time instead of decaying under scrutiny. This is the real lesson of the rise of FinTech. Technology reshaped the interface, but character reshapes the outcome. Financial services touch people at their most vulnerable moments, when they are afraid, hopeful, desperate, or dreaming. And any system that handles money without respecting that emotional weight will eventually cause harm, no matter how elegant the code looks. The startups that truly reshape this industry understand that innovation is not about moving fast and breaking things. When the things you break are people's livelihoods, it is about moving deliberately and fixing what others normalized as broken for decades, even when that path is slower, lonelier, and far less glamorous than the headlines suggest. So if you are building in FinTech now, or thinking about it, understand what you are signing up for. You are not just creating an app or a platform. You are deciding how power flows, who pays friction, and who benefits from complexity. You will be tempted to trade clarity for growth, trust for speed, values for valuation, and the market will reward you for doing so in the short term. The only defense you have is memory, remembering why this industry needed disruption in the first place and who paid the price before you showed up with a better idea. If you can hold on to that memory when the pressure peaks, you have a chance to build something that actually deserves to last. And if this story resonates with you, if you felt that quiet tension between doing what's easy and doing what's right, leave a comment and share what part of this journey you're currently standing in. Because these conversations matter more than pitch decks ever will. And if you want more unfiltered stories from the trenches about building, breaking, and rebuilding companies without losing yourself along the way, subscribe to the channel and stay with me, because the real education in startups doesn't come from success alone. It comes from surviving long enough to tell the truth about it.